Hi, good afternoon, and thank you for joining us today. My name is Sarah Hare, and you have joined the Case for AGVT, our latest webinar. And joining us today will be David Bassanese and Craig Higson. Now, just before we start, and as is the usual procedure for our webinars, we will send a recording of the session and the presentation to all registrations. So we'll send that out this afternoon. During the webinar, you may be familiar with a widget on the right-hand side. Now that's for you to be able to ask any questions throughout. It's often the most popular part of the session, and we do get quite a few, so I encourage you to ask your questions early so David and Craig can answer them during the session. Also, before we do start, I am to remind you that anything we talk about here is general in nature. We're not taking into consideration any personal circumstances. So before you do make any investment decision, please speak to your financial advisor and take some advice there. As I said, joining us today, who you'll all be familiar with, David Bassanese, our Chief Economist. Also joining us today is Craig Higson. He's our Director of Advisor Business and very sort of familiar with the fixed income space. So an absolutely great expert lineup from BetaShares. Now, as we often do, I'd like to start with a bit of a poll. And the first one is a bit of education, so or to test your level of knowledge. So the first one is up there. Now, what happens to the value of fixed rate bonds when bond yields fall? Go up, go down, stay the same. So Dave put this in there just to gauge the level of knowledge, and I'm getting a big thumbs up. So yeah, most of you are spot on there. That's pretty good. All right, now we'll just close that one. And the next one, the next sort of poll that we're sort of interested in, and just to sort of get, you know, I mean, fixed income is such a popular topic, but you know, how many people are actually currently using fixed income or bonds in their portfolio? So, great. Yeah, right, split right down the middle, which is really good. So, I'll just share the poll. So, yep, most of you correctly guessing that the goes up, which is really good. And just as I alluded to there, it's a 50-50 split on the who's using, who's not. So hopefully we can give you something to think about today. Okay, so enough from me. I'll pass over to Dave and the rest of the webinar.
Thanks very much, Sarah, and thanks to great to be with you all today to talk about, you know, a very interesting asset class, often neglected asset class, but it's good to see. I think based on the survey, something like 50% of everybody listening are using bonds, and you know, as you'll see, you know, there is definitely a case to be made to have some element of bond exposure within a diversified portfolio. And certainly government bonds as well. So what I'm going to do, I'm going to cover the first couple of parts of this presentation, the economic outlook at the moment and where interest rates are going, and then again just to go through the case for bonds in diversified portfolios. So firstly, look, and this should be no surprise to many, that we have been seeing particularly in the past year, quite a notable decline in bond yields. So if you were holding fixed rate bonds over this period, the value of those bonds has been going up, as I'll explain in more detail why you do get that relationship. But interest rates have been falling, and look, they are very low. I would say, though, that there is still a risk that yields can fall somewhat lower. Certainly, if the global growth slows a lot more, the RBA is still talking about cutting interest rates. There's definitely scope for yields to fall somewhat more, but nonetheless, they are now at pretty low levels. One of the key drivers of that, as you'll see in the next slide, is that global growth has slowed down. We're not yet talking global recession or anything like that. I guess a single summary measure of global growth is what's called the market global PMI index. So really, it's a survey of manufacturing and services across all the major economies of the world. And when that index is above 50, it shows overall, growth going pretty well. And I've put in there, what I've called, tongue-in-cheek, the Goldilocks zone. So somewhere between 50 and 55 shows growth is good, but not too hot to cause rising inflation. When you're below 50, growth is pretty weak. So we had a mid-cycle, what's called a mid-cycle slowdown, i.e. slowdown but not recession, back in 2016. The markets have recovered somewhat. We've been staying in that range, but with the global trade wars, we have slowed back down to that close to that 50-point mark. So that's really what's driven things so far. The other feature is the fact that inflation in the US does remain quite benign. And so that has allowed the Federal Reserve, which was raising interest rates in the United States last year, to now move to an easing bias. And in fact, you'll see the Fed almost guaranteed to cut interest rates next week. And the markets are pricing in a few more rate cuts over the next 6 months. I think they'll do at least one. Whether they do more, I think does remain to be seen in terms of how global growth flows. But certainly the bias on rates for the foreseeable future remains to the downside globally. And even the ECB overnight, the European Central Bank came out and talked about possibly boosting its stimulus as well, cutting their short-term rate, which is already negative, further into negative territory, which I believe. The development in Australia is also conducive to low interest rates and potentially further RBA rate cuts, as I alluded to. So a few key indicators there. The National Australia Bank Business Conditions Index has weakened. It's now close to its longer run average. In fact, a little bit below that average now. The unemployment rate has stopped falling. It started to gradually tick back up again. So that's now at 5.2%. I actually think that's probably going to edge up to about 5.5% by the end of this year. And possibly a little bit higher next year. And the reason for that is the downturn in the housing construction sector principally. As you can see from that third chart there, building approvals starting to turn down. So housing construction, which has been a big boost to the economy in recent years, will start to reverse. And also the flatness of house prices up until, not only flatness, the weakness of prices. I mean, Sydney property prices are off something like 15% from their peak levels. Has started to take effect on consumer spending, which is 60% of the economy. So all up, growth does look sluggish for the foreseeable future. ANZ job ads also, it's a pretty good lead indicator of the unemployment trend there as well, which is, again, stopped. It was rising, job ads were rising, but now they've topped out and have started to decline. So that suggests the unemployment rate will edge higher. Also, at the same time in Australia, inflation remains quite low. The RBA was hoping that wages growth would start to pick up over the next few years, but now with the expectation that the unemployment rate is no longer falling and if anything may rise, I don't think we can expect wages growth to pick up a lot anytime soon. At the same time, underlying inflation, most measures of underlying inflation in Australia are still stubbornly below 2%, below the RBA's 2 to 3% band. Bottom line of all of that, if you look at the central policy rate, so the RBA has already cut rates by 50 points from 1.5% official cash rate to 1%. I actually think they will cut another 2 more times. I've had that view for a while. and so by February next year we'll have an official cash rate of 0.5%, if I'm correct. Policy rates globally also, I mean, Japan and Europe, as you can see, there's only so much they can do. Official short-term interest rates in those economies are already negative. All they can really do is push them further into negative territory, which I question. But the US, after having raised rates for a while, can ease policy if need be. And as I said, I think it will cut rates back to 2% over the next few months, and we'll get the first rate cut most likely next week. So what about bonds? So that's really the backdrop. Interest rates have fallen. Policy rates at least are likely to fall somewhat more and then remain on hold. So unless you think there's going to be a big rebound in inflation, or central banks are suddenly going to switch and start talking about raising rates, bond yields are likely to stay reasonably low and may fall somewhat further over the next few months. What I want to do now is go through the case for bonds and really just a bit of, really back to basics first, just so we're all on the same page and very familiar of the way bonds operate, and then as a result understand how they are affected by changes in the economy, such as with interest rates. So firstly, here is the bond basics number one. This is a case of a 5-year bond, so a bond with a 5-year term has a coupon rate of 5%, which means if you buy that bond for $100 and the coupon rate is 5%, you'll be getting a $5 interest payment on an annual basis from that bond, and the principal being $100. So the way that would work is you would buy a bond today for $100. In exchange, you'll get a nominal payment of $5 every year for the next 5 years, and at the end of those 5 years, you will get your $100 back as well. So the total, you're getting 5 allotments of $5 plus your $100 back at the end of the 5 years. And that's how a bond works. So there's various elements there. A is the term of the bond, how long those payments will go for before you get your money back. What that coupon rate is, which really sets what the nominal value of your interest payment will be, is also critical, and obviously the upfront principal payment. Now what that means is, effectively, there's an inverse relationship between the value of bonds and market interest rates. So again, if you buy a bond with a coupon rate of 5%, now that may have been a good interest rate at the time you bought that bond, but interest rates, as we all know, do change over time. So let's say, for example, you bought that bond and it was paying you, you paid $100 for that bond, it was giving you $5 a year, and all of a sudden market interest rates decline from 5% to 4%, decline from 5% to 4%. So if you were to buy a $100 bond with market interest rates of $4 now, 4%, you would only be getting $4 interest income rather than $5. So all of a sudden, your $5 payment looks pretty attractive. And the way that works is that basically for your bond to be giving a market rate of 4%, the value of your bond will go up in price. And so as an example there, for a 1% decline in interest rates on that 5-year bond, the market price of the bond, were it to happen instantaneously today, a minute after you bought the bond, would go up to $104.05. So that's why when market interest rates decline, the market value of bonds tends to rise, because the fixed nominal value, the present value of those fixed nominal income payments you're getting are worth more in today's dollars. And by consequence, when interest rates rise, as you can see in that second example there, the market value of your bonds down, because the value of the bond needs to be reduced so that the nominal income payments you're getting are giving you effectively a higher yield on those bonds. So that's point 2, the inverse relationship, very important feature of fixed term bonds. The second feature is that the sensitivity of a bond's price to interest rates is dependent on the duration of that bond. Basically, over what time period you can expect to get nominal income payments before you get your principal repaid at the end. So here's an example of a 10-year bond as distinct from a 5-year bond, and as you can see, everything else is the same, but because you're getting that $5 over 10 years rather than 5 years, the capital value, the upfront price value of that bond is more sensitive to rates. So a 1% decline in prices gives you an 8% increase in the value of that bond today versus only 4% or 4.5% in the case of a 5-year bond, and vice versa. So the second key point here, the longer the duration of the bond, the longer the time period over which it pays nominal income payments, the more sensitive is its price to changes in market interest rates. So, and you can see that from just this slide here. So the longer the duration of the bond, so when I mean duration, again, it's really term to maturity, or just think about it in terms of the time period over which bonds will be paying you income payments. And so the longer that duration, the higher the, sorry, I've got ahead of myself here. Because of that greater sensitivity to interest rates, because longer duration bonds are more sensitive to interest rates, the values can be more volatile, you know, over time. For a given change in interest rates, the value of those bonds will bounce around somewhat more. So in exchange for that, the market tends to reward you, if you're prepared to take that volatility, with a higher interest rate. So bottom line there is that higher duration bonds tend to offer a higher interest rate than shorter duration bonds. So that's another important feature of bonds. There's that relationship. The next point is that, so that's duration. So the longer the duration of the bonds, the higher the yield you can expect to get from that bond. The other element to bonds is that they have different credit ratings. So for example, a government bond is a relatively safe bond because, you know, for the government to not be able to repay its debt, you're basically very unlikely in developed countries such as Australia. You know, sovereign bond defaults are very rare. You basically need a country to go bankrupt before that would happen. So it's a very low risk. Whereas the risk of, say, a private company, you know, Qantas, or, some of the big major companies out there, it's still a probably pretty low risk that they would get their financial difficulty to be so bad that they couldn't pay off their bond. But nonetheless, it would be somewhat higher than for a government. So typically you'll see corporate bonds for the same duration will be offering you a higher yield than government bonds because of that higher credit risk. Overall though, given all that, I mean, what is important to also remember is that the volatility of bond returns over time, which is partly the interest payments you're getting on a regular basis, but also the change in the capital value of those bonds. Certainly if you're holding a big diversified portfolio of bonds, such as the Bloomberg, in that case, a bond index, so that's an index of all the government bonds available in Australia. You can see the annual percent change in the value of that bond index is much less than what you see for equity markets. Not only that, as you can just probably glean from that chart, it's inversely related. So when equities have big declines, the value of those bonds tends to go up. So you can see that most clearly during the GFC period in 2008, then again in 2014, and then again earlier last year. So there is that inverse relationship, which I'll dig into it in a bit more detail now. So if we go to the next slide, this is why that inverse relationship exists. Because if you look at it, when equity prices tend to decline, interest rates tend to decline. So bond yields tend to fall. And they tend to fall because there's a switch out of equities into bonds. People are seeking the safety of bonds, and so the yields people demand to hold bonds tends to fall. So the market value of those bonds will go up. But also central banks, usually in periods of economic weakness, weak equity markets, more inclined to cut interest rates, which feed through to bond yields. So again, very important key thing to remember here. When equities are in periods of weakness, you'll usually see bond yields falling, which, as I've explained before, does mean that the market value of those bonds will tend to go up. Now, the other feature though is that although overall market interest rates will decline when equities sell off, what's called the credit spread, so the difference in yield between, say, corporate bonds and government bonds does tend to widen. So because of the higher riskiness of corporate bonds. And so what you may see is that if yields are falling, corporate bond yields may well fall as well, though they won't fall by as much typically as government bond yields. So the spread, the interest rate differential between corporate bonds and government bonds tends to widen out. So what that means effectively is that for a given duration, for a given term to maturity, a government bond will tend to perform better than a corporate bond when equities sell off. So giving you extra protection, extra downside protection in periods of equity market weakness. So again, that's an important point to remember. But overall, as you can see from the bottom slide here, is that the key result of all of this, and which is very important when you're thinking about holding bonds within a diversified portfolio, is the negative correlation between bonds and equity returns generally. So when equities are selling off, typically bond yields are falling and the value of bonds are going up, and so the return on your bond holdings will be positive. As you can see there, most clearly in December 2008, had a big decline in the equity market, and bonds had a pretty good return. And even when equity markets rebound, I mean, because you're still getting decent interest rates, you know, it's generally the overall return on bonds, you know, it's rarely negative. Total return rarely can be negative, but through the whole recovery since the GFC, you've still been getting positive bond returns over that period. Now, so that negative correlation, again, I just want to dig into some of the details as to why that is so important. Now, this is a little bit complicated, this slide, but if you don't follow it with me immediately, just maybe a bit later you might want to look back on it. But basically what it's showing you is a portfolio where you've got 100% allocation to bonds and another portfolio of 100% allocation to equities. And you can see the return, the expected returns and risks of those two portfolios. So obviously an equity portfolio giving you a 10% return, but a much higher volatility, 15% volatility of those returns, versus only a 5% return on bonds, but much less volatility. And so what I've got here are some examples of if you blended a 50% exposure of bonds and equities, whereby, say there was zero correlation between the two, the net result is that you'd effectively, you're just getting the return, basically irrespective of correlation, the return, the long run return on that portfolio would be the same. It's basically, you know, it's the weighted average of the bond and equity returns, it's about 7.5%. So that's going to be the same, but the important point is that the volatility of that portfolio is reduced when the correlation of returns between bonds and equities are negative. Because again, if bonds are doing well when equities are doing poorly and vice versa, the overall volatility of your portfolio will tend to be less. And so as a result, as you can see from that standard deviation, it's a lot less. And so bottom line there, whereas if equities and bonds move together, that you would get, in the case of a positive +1 correlation, you get 4 negative return years over a 20-year period. On average, that's what your expectation would be. Whereas if it was a -1 correlation, the number of negative return years over 20 years, as calculated, would actually halve to only about 2 out of 20. So you can, that again, that is the bottom line. That is the way in which bonds can help reduce the volatility of your portfolio, which you can take two ways. You can either say, okay, I'm happy to do with that, and I'll take the reduced volatility of my portfolio for the same return, or you can then say, well, given I've got less risk, I can now take less volatility, I can take on a bit more risk, you know, and have a bit more equity. So you can basically play it two ways. So just to summarise, really, just to go through some of those basics, this is really the summary. So fixed rate bonds offer fixed nominal income payments over time. There's a negative relationship between bond prices and market interest rates, as I hope I've explained. Longer duration bonds, because they are more price sensitive to interest rates, longer duration bonds are more price sensitive to interest rate changes, but as a result, they tend to offer higher interest rates over time because of that extra volatility. But if the correlation between bonds and equities is negative, even though longer duration bonds may be more volatile in and of themselves, they may not be that volatile when held alongside equities because of that negative correlation. Interest rates tend to fall and credit spreads widen. So again, government bonds will tend to do better than corporate bonds, all else constant, when equity markets are weak. Bottom line of that, longer duration, high quality government bonds tend to offer enhanced downside protection where equities fall. So that is the role of government bonds. If you get long duration government bonds, they're really going to give you the best downside protection in periods of equity market decline. So with that, so all that thinking, that's the thinking behind our decision to come with an Australian bond ETF, which again, it's not the first government bond ETF in the market, but we think it's very desirable in terms of the characteristics we've created for this ETF, and I'll hand over to Craig to talk about.
Thanks, Craig.
Thank you. Thanks, David. Thanks, Sarah. So, yeah, and thank you all for listening. So, yeah, now what I would like to do is just talk a little around or introduce the new BetaShares Australian Government Bond ETF, ticker code AGVT. And what this fund is designed to do is to track an index of a portfolio comprising predominantly Australian government bonds, but more specifically long duration, high quality government bonds. So for bonds to be in this portfolio, they have to have a duration between 7 to 12 years. And I might start just by looking at where this product fits within the existing suite of BetaShares fixed income offerings, which I'm sure many of you are familiar with. So what we're looking at here is the two risks associated with fixed income investment, being interest rate risk or duration on the vertical axis and credit risk along the horizontal axis. And clearly, the fund that has the least exposure to both of those risks is the cash ETF, BetaShares' largest ETF, AAA, which holds cash deposits and clearly is the lowest risk in there. If we look at moving along the horizontal axis, so the next fund there is Coupon, the floating rate bond ETF. So Coupon holds senior floating rate bonds from Australian banks. So slightly higher credit risk, but whilst holding floating rate, no or very little interest rate or duration risk in there. And then moving further to the right, you've got Hybrid, the active hybrid ETF, which holds an actively managed portfolio of hybrid securities. Once again, floating rate securities, so little to no interest rate risk. Moving up the interest rate risk spectrum, we've got the active Australian bond ETF run by Legg Mason and through their Western Asset Management. So that's an actively managed portfolio that holds a combination of government and corporate bonds, and clearly holding some interest rate risk, so holding some duration in the portfolio. CRED is the Australian Corporate Bond ETF, which was launched a little over a year ago and was actually the highest returning fixed income investment in the Australian market over the last year. So it holds a portfolio of investment grade corporate bonds with a duration of around 6 years. So holding some interest rate risk, but also holding credit risk through a portfolio of investment grade corporate bonds. And then the fund that we're talking about here today, AGVT, the government bond ETF. So it has a portfolio of highly rated government bonds, so little to no credit risk, but has the longest duration of the suite. As I mentioned, holds a portfolio of government bonds with a duration of 7 to 12 years to maturity, and currently sitting around the 7.5 years. So what does that look like in terms of the portfolio? So the portfolio holds around 53% Australian government or federal government, Commonwealth government securities, around 22% state government securities, almost 13% of supranationals, and then some other government agency or organisations in there. The portfolio, that adds up to an overall credit quality of 86%, being AAA rated securities. And David talked a little around the role of credit risk in a portfolio. In times of economic stress, both equities and indeed even corporate bonds can come under market pressure. Highly rated government bonds are likely to sort of continue to be that safe haven or that sort of lowest risk opportunity where investors will move to in times of economic stress. So if we look at the next slide of what the constituents are, or what the ratings of the bonds are. The thing to be aware of is that in a post-GFC world, there is a relatively low pool of highly rated government bonds around the world, and Australia fits in as one of those sort of small number of issuers that have the highest rating from the various credit agencies. Combined with that, you've got an Australian government debt level that is incredibly low, and you can see that in the chart on the right-hand side. So by global standards, government debt as a percentage of GDP in Australia is very low. If we look at what actually makes up the portfolio, and we've got the top 10 holdings there. So as mentioned before, around 53% of the portfolio is Australian government or federal government issued securities. And then you've got the various other issuers in the top 10 there. One thing perhaps worth pointing out is that in order to get into this index, or indeed any Australian bond index, bonds need to be issued in Australia, in Australian dollars, under Australian law. So you will see entities, supranationals like the World Bank in there that fall into this index, and indeed most Australian bond indexes, by virtue of the fact that they are Australian issued in Australian dollars under Australian law. In order to get into this index, the securities need to have some government shareholding, government-backed securities, hence entities like the World Bank and the like that are in that portfolio. If we look at government, or this government bond ETF versus other government bond indices that are in the market, a couple of sort of highlights of what differentiates AGVT's index from others is that we talked about the duration, and AGVT will give you the longest duration or the most interest rate exposure versus other government bond or bond ETFs or indices in the market. So it has a modified duration at the moment around 7.8 years versus the Bloomberg Government Index at 6.1. David mentioned the role of duration as a diversifier in a portfolio, but more broadly, the longer duration will give you a more negative correlation to equities historically in times of stress. The other thing is that AGVT's index, by holding longer dated securities, doesn't have short dated government bonds that other indices have that basically offer yields at or less than cash rates. So overall, the index at a yield of 1.61 is higher than the potential yields available from other bond or government bond indices in the market. And if we look at what the experience has been for the index that AGVT invests into, and look at it on a historical or risk return basis, you can see that longer duration, high quality exposure has actually given a higher return over time. But more importantly, and David talked about the role of the negative correlation to equities and looking at a 50-50 blend of fixed income and equities in a portfolio. A 50-50 blend of AGVT's index with the ASX 200 would give you a similar volatility experience to combinations with other bond indices, but a lower maximum drawdown. So indeed a better experience for investors by stripping out some of the volatility from their overall portfolio rather than looking at the investment in isolation. If we go on to look at, and I think this next slide really makes the case for why bonds and why AGVT in particular in a portfolio, is that point around bonds being negatively correlated to equities and looking at some real world experience for investors invested in various times of equity market downturns. If we look at global financial crisis, 2008, equity markets down 30-odd% in Australia. A traditional Bloomberg AusBond Composite Index gave you a return of 14.3% over time. An investment in the index that AGVT tracks gave a return of 22.4% by virtue of the fact of holding highly rated government bonds with longer duration. So your negative correlation to equities was actually strongest in that period of the global financial crisis. If we look at 2011 as an example, once again, equity markets down 10%. Your traditional bond indices gave a positive return of 11, 12-odd%. Creds, our corporate bond index, gave a return of 13.9. The government bond index, 16.6. So once again, the most negatively correlated to equities. Similar experience in 2015-16, but looking at most recent example, the December quarter sell-off of last year, equity markets down 9-odd% for just over the December quarter. The government bond index returning 2.4% for the period. So if we think about why we hold bonds in a multi-asset portfolio, generally it would be to give some capital stability, to give some regular income, and all of BetaShares fixed income products pay a monthly distribution, but also to get something that's negatively correlated to equities. So something that traditionally will go up when equities goes down. And we think that that is where the argument for AGVT is perhaps the strongest as a component of a multi-asset portfolio. So hopefully that gave a good overview of the fund and where it sits, or where it potentially sits within a portfolio. And I might hand you back to Sarah now to take any questions.
Thanks, Craig. That was a great wrap up. So just again, some things to consider here. Obviously, investment risk. We've talked a lot about the interest rate and credit risk there. Obviously, no guarantees. So future outcomes are uncertain. Past performance is not an indicator of future performance. General information only. Again, we haven't taken into account any personal circumstances. Please seek professional advice before making your investment decisions. And then all of the relevant PDS information is available on our website, along with fact sheets, brochures, flyers, and further information, detailed information about the funds can all be found on the BetaShares website. Now, I might just stick with you, Craig. There's a quick question here, just in relation to access to exposure to rising interest rates. Is there a bond exposure that would give you access to an increase in bond yields?
Yeah, so I guess if we go back to the sort of that slide I started with, looking at the suite, is that those products that have floating rate or low interest rate exposure, so the ones along the bottom there, AAA cash, obviously if rates go up, your return on cash goes up. Similarly, coupon. So coupon holds all floating rate bonds. Hybrid holds floating rate securities. So if you're looking for an investment that is going to give a higher return as rates go up, then those floating rate bond exposures, AAA, coupon, hybrid, would fit that circumstance.
Okay, great. There is quite a lot of questions here. So perhaps a quick one. How did those returns look over the last 6 months with the share market dipping and interest rates going down? So I think the return on interest rates, perhaps. Yep, Dave, do you want to take this? Yep.
Well, I don't have the 6-monthly number here, but basically they've been pretty good. I mean, as you would expect, with interest rates falling, bond yields falling, the value of bonds goes up. So AGVT's index over the past year, so the year to the end of June, has been 11% return because of the decline in bond yields, which has beaten other government bond indices in Australia because of its longer duration. So it's been more sensitive on the upside to that decline in rates.
Okay, great. Maybe, I think, Craig, this is talking to the slide that you spoke to. Why the disparity between returns from bonds in 2011 and 2018 when equity market falls were of similar size? So it's just this slide here.
Yeah, slide 32.
Yep, slide 32. So, Craig, Dave, you want to pick that up?
Oh, look, obviously the difference, interest rates, basically the starting point for yields have been lower because of the trend decline in interest rates over that time. So again, in any given period, the two components of your fixed income return will be A, the yield you get, and B, whatever happens to the capital value of those bonds over that period. So if the starting yield is lower, then your starting point return is going to be lower. And I think in 2015-16, we basically didn't get as much of a sell-off in the bond market in yields as we got previously. In fact, if you recall back in 2016, part of it was what was called at the time a taper tantrum, where the central bank of the US central bank, which had been buying bonds for a long time, had basically said we're going to stop buying bonds. We're actually going to start selling back some bonds to the market, and the market did get spooked at the time, and bond yields actually lifted somewhat, and then that actually caused the equity market to sell off. But then with that, the bond yields actually then came back again. But bottom line of all that, you didn't get much of as big a bounce in bond returns as you got, but nonetheless, it's still positive, and certainly going in the opposite direction to the equity market.
Mm.
I think that's it. That's the important point, is rather than perhaps the quantum, it's just the direction, is that you're getting that negative correlation to equities.
Mm-hmm. Yeah. Just a sort of related, somewhat related, what's the likelihood of another bond market crash like in 1994?
Look, I think pretty low. If you go back to 94, there's some obviously some people out there with long memories. That was the bond bloodbath, as it was called at the time. And basically what happened is US inflation was starting to pick up at the time. Unemployment was quite low, and the Federal Reserve surprised the markets and quite aggressively increased interest rates through most of through most of 1994. So it completely took the markets by surprise at the start of the year and aggressively raised rates through much of that year. And so that was like a worst case scenario for bonds. At the end of the day, inflation didn't really pick up, and the year after the Fed started, reversing course. But so bottom line, it can happen, but you need to see a big pickup in inflation, and you need to see a very aggressive change in central bank policy. And that looks quite unlikely at the moment because, from one of those earlier slides, inflation still quite low. It's still lower than central banks would like. That could, of course, change, but given globalisation, given technology, given these various structural forces keeping a lid on inflation, my central case scenario would be that's unlikely to happen.
Mm-hmm. And so, sort of, Craig, these sort of next ones for you. Do you have to keep adding to the investment, or can you just put in an initial amount and leave it? Obviously, this is talking about investing in AGVT. Yeah,
so you can put in an initial investment and leave it. That's fine. You don't need to keep adding to the investment.
Yeah, and then I think there's no minimum investment, but obviously some brokers do require an initial investment of $500, and then you can sort of go from there or not, if the case suiting you. And then, Craig, probably some pros and cons about receiving a monthly distribution versus reinvesting. So that's DRP versus taking the distribution.
Okay, so I mean, this is one that's obviously going to depend on the investor's personal circumstances. Clearly, if I reinvest, I get the benefits of compounding. But if I'm a retiree and I'm looking to draw a regular income, then I'm not going to be doing that. I'm going to be taking the income on a regular basis. So that's one that's clearly going to be, well, that decision is going to be reflective of the investor's personal circumstances.
Mm-hmm. Yeah.
I mean, just a quick comment on the previous question. I mean, just to be absolutely clear, I mean, the AGVT is an ETF you can get on the ASX. You know, so you just buy it like a company share. So you can buy as much as you want up front and buy as much as you like going forward, just as you would a company share. So it's there's no regular investment program necessarily that you can sign up for, but it's up to your discretion to keep buying, you know, regularly, you know, subject to brokerage costs and whatnot, as much and as frequently as you like.
Yeah, yeah, and just to reiterate this is absolutely an ETF. So buy and sell like a share. We just had a couple of questions.
So very easy access, you know. The beauty of exchange traded funds these days is you can get, you know, much easier access to fixed income products, bonds, than you could in the past. I mean, it's really opened up this whole, you know, asset class that was once hard to access for investors. Now you can get it, you know, very easily on the ASX, hold it alongside your shares and your other equity ETFs.
And so the next question, so the inverse relationship is with interest rates, and this is obviously going back to your bond basics, Dave, not directly to shares. Can there be situations where shares are falling and interest rates are rising, making bonds and shares positively correlated?
For sure, yes, it's a very good question. Again, the negative correlation between equities and bonds is an historical, generally it's true historically, but I mean, if you do have it, but it hasn't always been the case. So for example, in the early 70s, when inflation was rising, you know, we had this stagflationary environment where inflation was rising, which was hurting economic growth. We had a period where interest rates were rising, bond yields, bond returns were weak, and equities were also weak. So in periods of rising inflation, which is hurting economic growth, yes, that correlation can break down. But typically what we've seen in history is that it's demand shocks that are affecting the economy, such that when equities weaken, it's typically a period where inflation is falling and interest rates are falling. So you definitely can't rule out that the relationship being positive. But in this low inflation environment, where I think it's demand shocks that are likely to predominate, I think that negative correlation will tend to hold.
Okay, and obviously this is quite a general question, but someone's saying, you know, presumably the older you are, the more attractive bonds become. Craig, do you want to take that?
Sure. I mean, I guess once again it comes down to personal circumstances. There's plenty of older investors that hold, you know, significant equity portfolios and have done for a long time and are comfortable with that. So I would say rather than perhaps regarding age, it's more about a client's risk appetite or risk tolerance. Certainly, historically, bonds are lower risk, lower return than equities. And what combination of those assets an investor has in their portfolio is going to relate to their circumstances, their needs, and their risk tolerance. But in general, you know, most younger investors should be encouraged to, or would be encouraged to invest in higher growth investments, given their longer investment time frame. Older investors with a shorter investment time frame potentially want more lower risk, higher income yielding investments in their portfolio. But once again, that's kind of generalizing. It's going to be related to an investor's individual circumstances rather than perhaps just their age.
Yeah, and we did actually do a recent, very popular webinar, Investing for Life Stages, and that really did talk about some objective-based investments. And so just sort of, you know, trying to sort of wrap it up, but one, for either of you, why is the unit price for AGVT, around $50 per unit.
Look, it's there's no particular reason. I mean, I guess the actual unit price per se doesn't really matter all that much. It's really just a nominal figure that has been chosen. It could have been $10, could have been $20, but you know, I thought, you know, I think the decision was just made to make it 50. It doesn't really matter in terms of, you know, your exposure. I mean, if the bond return is going to be 10%, it means it'll go from $50 to $55. Or if it was starting at $20, it would have gone from 20 to 20. You're still going to get the same percentage returns over time, irrespective of what the starting unit price would be.
Mm-hmm. Okay, great. Just before we run out of time, I'd just like to let you know our next webinar, upcoming webinar, it will be on our recently launched BetaShares FTSE 100 ETF. The ticker there is F100. David will be presenting again. We'll be joined by Alistair Mills. And we're just taking through an update on that economic outlook. Very topical, lots going on in the UK. So Dave's got a lot to talk about there. And then after that, and just so you're all aware, our next fund launching in the next couple of weeks is our BetaShares India Quality ETF. Much anticipated, and you know, get a lot of interest for that. So you won't have to wait much longer. That will be available very shortly. Thank you very much for joining us today. Really appreciate your time and interest in bonds, and also our latest fixed income exposure. And as I said at the start, copies of the slide deck and session will be sent around to you later today. So thank you very much. Thank you, David. Thank you, Craig.
Thanks, everybody. Catch you next time.
Pleasure. Thank you.